to the Tutors of Life podcast, episode 78. This is your host, Shaun Tutor.
And this is Sam.
This is going to be a tutor episode. We're going to start saying what kind of episode it is.
Oh, you don't think the title gives it away?
I don't know. I mean, maybe, but now it's double given.
There we go.
Yeah, love it. Okay, hopefully we can bring you some value today. If we don't, sorry.
I don't apologize. I don't know.
Oh, okay. Sounds good. All right, Sam, what are we talking about today?
We are talking about interest rates.
Interest rates. Thank you, Ryan, for bringing up the wonderful topic, because on March 17th, or 4 days ago, they did an interest rate hike.
Mm-hmm. Yes,
and they set out a plan for 6 more interest rate hikes for 2022. And then I believe 3 more interest rate hikes in 2023. So this interest rate increase they did was a quarter, so 0.25% interest rate increase. Yep.
What do they call it? 25 basis points?
25 basis points.
There we go.
And
so is each point just 0.01%?
Yes.
Got it.
So there's 100 basis points in 1%.
Yep.
And so they increased the interest rate. And they plan to do 6 more 25 or 0.25% interest rate hikes.
So this is from banks? Or what does this affect? Like just mortgage rates?
No, this would affect a plethora of things. So if the 10-year treasury yield, I think it is 10-year treasury yield,
yep,
if that goes up due to these interest rates going up, which it's most likely going to, then mortgage rates increase. But this increase from the Federal Reserve, what this means is the bank now has to pay more money to get money.
Okay.
So the bank has to pay a higher percentage to get money.
Okay. So then banks are obviously going to charge more money.
Charge us a higher percentage.
Yes, okay.
To consume things.
Once I read this, because it said this is the first hike they've done since 2018.
Yeah.
Then I realized it wasn't just because I remember, wasn't it all banks just raised their interest rates a couple months ago?
For mortgages.
Yeah.
Yeah.
So the entire time we were learning about this today, I was thinking it was talking about that. So I figured all banks had just raised their interest rates 25
right. Yeah. So it's the Federal Reserve rate. The Federal Reserve raised interest rates.
Got it. So banks borrowing money from them has now raised.
Yep.
Or interest.
And so now that that's raised, now consequently, well, you'd figure banks are going to charge us more money now, a higher interest rate, to borrow money because it's costing them more money.
So do you think banks raised interest rates at the beginning of the year, in preparation for this? Or no?
Yes. Well, so there was a lot of uncertainty. What happened was, if anybody's been following it for the past 3 months, at the beginning of 2022, they were talking we're going to do a gradual interest rate increase. Mm-hmm. So nobody panic, it's not going to be a big deal. Inflation's not going to kill us, all this stuff, right?
Right.
Then they came out that inflation was 7.5% for the last quarter of 2021, I think.
Oh, wow.
Yeah, inflation was at 7.5%. And then Jerome Powell was just so actually, guys, we lied. Let's panic. We're going to hike up rates. So then banks started raising rates, just pretty much in preparation for the uncertainty. And so now the good thing is they have a plan. Mm-hmm. They laid out their plan, right? So in a perfect world, they're going to stick to their plan. And if they can stick to their plan, that is very good for us consumers, because there's not going to be essentially uncertainty and scare in the markets.
Mm-hmm. And that's what the one, who is Graham?
Yes, we watched a few different people today to like get some of this content, read some articles, watched the address and stuff like that. But I think it might have been Graham Stephan. What was he saying?
How they talked about maybe raising it 50 basis points. Was it the next one or the one after that? But he's like, that's probably just unlikely because that will just cause mass chaos.
Mm-hmm.
Because they've already kind of announced their plan right now.
Yeah, yep. So as long as they stick to the plan they announced, I think things are going to be, it's going to be okay. But we're going to break down some of the things that we can expect, and things that might be able to help us move forward. Right?
Yes.
Cool?
Sorry,
okay.
I have a dog now.
You have 2 dogs. Okay, what do we got, Sam?
Should we talk about the Ukraine first?
Oh, sure. Okay, so another thing that's playing a role, right? So right now, inflation's high, okay? Which means demand is very high. Goal is to by interest rates coming up, the hope is to bring demand down, and by bringing demand down, inflation can come down, okay? Mm-hmm. But so right now, we have the Ukraine war.
Right.
Now, every time we have uncertainty, so we saw this earlier in the year when there was uncertainty of what was going to happen with the Federal Reserve increasing interest rates, okay? There was uncertainty. Now there's a Ukraine-Russia war. That is also uncertainty. So that can cause a lot of things to go in weird directions. It can also hurt supply chain, right? And supply chain being hurt can affect our demand, and that can actually increase inflation. Also,
which we witnessed with toilet paper in 2020.
Toilet paper in 2020, we witnessed that extreme inflation in cars right now because of the chip shortage, right? Mm-hmm. So extreme demand, minimal supply. Mm-hmm. We saw that with gas over the last few weeks. Mm-hmm. Right? Because they're afraid that we're going to be shut off from the oil supply. However, right now, we see gas prices going down. Speculations of why gas prices are going down right now is there is another COVID outburst of sorts in China. And with that, there's less demand from China for fuel because lockdowns and shit, because they're still doing that kind of stuff. So they're doing less driving right now, which is good because that extra oil that they usually get, we can now get, right? Mm-hmm. So that is a speculation of why we are seeing gas prices drop now in the past 5 days.
So, okay, cool. Actually, I'm not going to ask my question because that is not about interest rates. So.
Okay.
What is margin debt?
Okay, so now we're getting into the pros and the cons of interest rates going up. Interest rates going up, why this can be a pro. We're going to touch on the quick pros, okay? Quick pros of why it's going up.
Yes.
We hopefully can help curb inflation. Inflation's high right now because the Federal Reserve thought it'd be really dope to print over $10 trillion in the past 2 years.
Geniuses.
Yeah, so Federal Reserve out there being smart, print over $10 trillion. Now they're like, hey guys, we got to raise interest rates to help bring down the inflation that we just created that we're blaming on the Russia-Ukraine war.
Even though it's been going on for 2
years. Yep, makes sense, Federal Reserve. Thank you. So with the high interest rates, right, helping curb inflation in theory, right? So that's good.
Yes.
Second thing, this is not going to happen right away, but it might happen down the line, maybe in a year. Is right now, if you have money in a savings account not being invested, you are making dirt, okay?
Aren't you losing money technically?
Yeah, you're technically losing money because inflation's so stupid. But with like high yield savings accounts like Ally, Capital One, or not Capital One, what the hell? American Express has one, I think.
I don't know.
Ally, American Express, whatever. High yield interest savings accounts, right? Ally's the biggest one I know of. Anyhow, their interest rates will go from, they're at 0.5% right now, to, in theory, up to 1 to 2% before the whole COVID thing. Some of them were at 2.5 to 2.75%.
Yeah, wasn't Ally at 2.75?
When we first signed up for Ally in 2019, it was at 2.75%, which is actually more than inflation. So you're actually making a little bit of money by having your money in a savings account. That is not the same now.
We also, just for fun fact, probably got our Ally accounts 4 months before COVID.
Yep.
And as soon as COVID hit, it just steadily dropped 2.5, which is probably what it's been at for the past year and a half.
Yeah.
Almost, no, year and a half.
Yeah. So
that's the pros.
That's the pros. That's the main, more pros of interest rates going up.
We'll probably get to some in here.
Yeah, maybe. Okay, let's go to cons. All right, there's a thing called margin debt. So people that like to go on Robinhood, they like to trade stocks, they like to trade cryptos. Right now there's a thing called margin debt. Essentially, it is a loan. You get to loan out money at 3%, 4%, 5% interest rate, whatever, that you then take and throw into stocks, more stocks. If you reach a certain level of debt to margin ratio, they can call margin, okay? What that means is, I don't know the exact amount, and it actually changes depending on the, like the risk of the stocks and stuff like that, the risks of the cryptos, things like that. So if you have, say, 40% margin debt, 60%, like 60% of your own equity, and you tick down and say your margin is called when you are at 50% and 50%, right? So when you're even, your margin debt's called, so then you'd have to start paying off some of that margin. The problem is right now, what could happen, and this is, if there's uncertainty, this will most likely happen. If we can keep the uncertainty to a minimum, most likely this won't happen, okay? Stocks are at
they're at a low.
They're at a super low right now. So if we keep things certain and there's not scare and uncertainty, they should slowly start climbing up. Interest rates, though, are going to keep hiking up and hiking up. Typically, when interest rates hike up in the Federal Reserve, stocks start to go down, okay? But we're in a weird time in the world, and it has happened in the past where interest rates go up, but stocks still keep going up. But typically, interest rates going up, stocks going down.
Which is incredibly, because stocks are already so far down.
Right, and so here's where it could be an issue. People have been using margin, okay? They've been using margin as stocks have been coming down over the past 16 weeks. They've been coming down. I think 16, 20 weeks stocks have been coming down for. So people have been getting margin and putting margin into their stocks. Their positions keep getting slimmer and slimmer and slimmer. Their positions are getting tighter and tighter, where they are chipping into their equity more and more and more and more. Some people are getting margin called and having to put more money in to not have all of their margin called, right? To keep their equity position above what they call margin at. And so, essentially, your little loan, okay, right now, we keep chipping away at the equity by stocks continuing to fall. If interest rates start going up a lot and stock prices keep falling, that's more people's margin debt is going to be called. That's more people are going to have to essentially pay themselves out of a hole paying off their loans. Okay? Okay. Here's the second problem about margin debt.
So that's kind of similar to like foreclosures on a house? Or no?
Yeah. Oh, okay. So it would be a foreclosure on the house in the fact that you have a loan and you're not paying your loan, right? So that would be the same thing if your margin is called, but you're not paying your margin. They're going to start taking your equity in your other stocks. Like they'll just sell your stocks and shit and take it. So yeah.
Anyways, continue.
So what is neat here, right, is most margin is a variable interest rate. So with a variable interest rate, say right now your margin's at 3%, you're borrowing at 3%, life's hunky-dory. We have interest rates going up in the Federal Reserve. People are going to change what their margin is. So now your margin might go from a 3% to a 4% or a 5%, maybe a 6%, whatever it is. You're going to have your margin percentage increase, which means you need to make more money on the margin to pay it back, but you're already hurting because shit keeps plummeting because interest rates continue to go up. Mm-hmm. So it's kind of like a double whammy. If you're holding a lot of margin right now, hopefully you can pay some of that off. If those interest rates start to hike up quite a bit. Mm-hmm. So just, be prepared in that realm.
Yeah, and that's what a lot of them are saying, where right now is a good time to start paying off your debts.
Yep.
Credit card debts especially, because those rates are super, super high.
Yeah, so credit cards, right? We'll get into credit, or you want to talk? You talk about credit cards.
I'll talk a little bit.
Yeah, go.
We just lost the dog. That's okay. So credit cards, yeah, their interest rates are variable.
Yep.
So for credit cards, because their rates are so much higher than home loans, it goes up so much faster. So they said right now, if your credit card percentage is at 15%, it can very easily go up to 20 or 25%.
Yeah, they said for every quarter it goes up at the Federal Reserve. You can expect to see a 1% increase on your credit cards.
Yeah, so it can vary.
Four times the amount.
Yeah, it'll very quickly get up there. So definitely start paying your credit card debt. And the one video we watched, he was showing how much people are in debt, on credit cards and student loans.
Yeah.
It's on average $28,000 per person.
So the average millennial has $28,000 in consumer debt. Mm-hmm. Which would be credit cards or a car.
Yeah.
Or really credit cards, car, personal loan, shit like that, consumer debt.
Car rates variable?
Car rates are typically not variable, but we'll see car interest rates increase as the Federal Reserve interest rates increase.
That makes sense.
Yep.
And then also if you have a student loan with a variable interest rate, that is also going to go up. Obviously not as crazy.
Right.
As credit cards, unless if you somehow had a student loan that had crazy high.
That wouldn't make sense, no.
I think there were some companies that, it's almost like a credit card.
Jeebus.
With student loan debt.
That's okay.
Yeah. Luckily, all my student loans, it's a fixed percentage rate, so I think when I got them, it did vary. So I think there were some years I had a 4.25, and then other years I had a 2.75. So when I started paying them off a couple of years ago, I made sure to put extra on all the ones with the higher interest rates.
Right.
And then everything went to 0%. So
did you know that that's not what you're supposed to do? Dave Ramsey would have been mad.
Yeah, whatever.
Okay, go ahead.
What else did you want me to talk?
Okay, so.
Oh, car rates.
Car rates are going to do the same thing. They're going to go up.
Meet Kevin doesn't think prices are going to go down for cars, though.
I don't think prices for cars are going to go down until they can figure out the chip shortage.
Yeah, which if interest rates go up, then hopefully less people start buying cars, so then the demand of them will go down. So
that will bring the price down.
Yeah.
Yep. To help curb inflation.
Yeah.
Kind of comes full circle.
It really does.
We have next HELOCs, home equity lines of credit.
Oh yeah, and ARMs.
These can be variables. So an ARM is
Amortized.
Isn't it? Yeah, damn it, I know this, guys. Anyways, what it means is you have an ARM for a loan, and depending on the terms you set up, depend on what the interest rates, how do I say this? Okay, so.
Depends on the length of the ARMs.
The length of the ARMs.
It's usually 5, 7, or 10 years.
3, 5, 7, 10.
And I think we did hear someone say they've heard of 15.
15, that's agency debt, though. We're not talking about that.
Oh, okay. Oh, whatever.
I mean, it's real.
Yeah, but it's just the length of time that you can lock in a interest rate.
Yes.
Do most banks do it like Wisconsin, where if it's
No.
Okay.
Most banks, you have a maturity date. So after 5, I'm going to give you real life examples. My current rate is 4.5%. I lock it in for a 5-year arm over a 25-year amortization. So my loan length is 25 years, 25-year amortization. I have a 5-year arm. So at the end of 5 years, my note is due. It's done, right? I need to sign another arm. So at the end of that 5 years, I need to sign another arm. It doesn't matter what the interest rate's at. You're signing another 5-year arm or paying it off or paying off the loan at 5 years.
I think I remember at Citizens, you could renew it like a year early, like only 1 year early.
Okay, if interest rates are good.
Yeah.
We can also do that at Wisconsin. The guy said, we'll get into that in a minute.
Okay, sorry.
End of the 5 years, boom, I need to get into a new loan, okay? Whatever the interest rates are, that's what I'm getting in at. So if I had an arm with a variable interest rate coming up in the next year, knowing that Federal Reserve's going to increase over the whole year, it's going to go up 1.75%. As long as they stick to the plan, it's going up 1.75%. That's big.
And that's just this year, right?
That's just
and then you
this
said
year.
Another 3 next
Another
year?
3 next year would be another 0.75. So I mean, you got something coming up at the end of the year. You're not in a good spot, Chief.
Yeah, you better see if you can sign early now.
Yeah, absolutely, because you're going to be locking in at a high interest rate, right? Now, that is the typical ARM setup, right?
Right.
Our HELOC for our primary home is fixed interest rate.
Yes.
But our line of credit we had with a different property that I don't currently have anymore was not fixed. That was variable.
Oh, so that's dangerous.
It was 1 year. It was 1 year arms. 1 year arms.
Oh,
1 year arms
okay.
for that. Yep. She had to re-sign every year with the new interest rate.
That sounds awful.
Yeah, it can set you up for failure, and that's where a lot of people, you gotta fucking utilize these things, right? You cannot be foolish with this stuff. You don't get a HELOC on your home to fucking build a new deck.
Right.
You don't get a HELOC for consumer shit. Foolish. You get it for investing. So I max out my HELOC all the time.
But we pay it off.
But we pay it off when we sell a property or whatever.
Right. So we only have it for a max of like 2 months, maybe 3?
3, right. So, okay, worst case Ontario, that rolls into the next year. You have to sign and you get hit with a couple months of high interest rates.
Yeah.
Dude, it's not a big deal. You utilize that money for a real reason. Say you're the average Joe and you got a HELOC or a line of credit for consumer debt and you're just making your $40,000, $50,000, $60,000 a year, but you got to pay off $20,000, $30,000 before that thing hikes up, you're the individual in a tough spot.
Yeah.
And so people got to utilize credit smart.
Oh, yeah. And we have other podcasts about that as well, about good debt and bad debt.
Oh, absolutely. So, right now, our one HELOC, though, I'm pretty sure is fixed for, like, a while.
That's what I thought, because when they mentioned that in the video, I do not remember them saying that our interest rate was, because I'm pretty sure it was locked in at, like, 3.5 or something, or 4.25?
It's at 4.5.
4.5.
We chose 4.5. We locked it in at 4.5% interest rate. I don't remember, for 10 years. 4.5% interest rate for 10 years.
So we should really get so when we get our house reappraised, do we just get to keep that HELOC and they just get to raise like the value of it? Like, you know how
I see what you're saying. I don't know. I think we'll ask them that before we do it, because if it's going to hike up a lot, we're just not even going to do it.
Right. Because that's what I'm curious if it's just like credit cards where they're like, oh, like we increased your limit to blah, blah, blah.
Right.
But like everything else stays the same.
Right. on to the next thing, gang. So that's HELOCs and variable.
Ooh, housing prices.
Oh, let me finish with the Wisconsin thing, right?
Yeah.
Just so people
Understand.
At Wisconsin, I did a portfolio loan. I chose them for a reason. I shopped around and I found a good place to get my portfolio loan because I conglomerated 8 properties.
And this is why, like, this is a good example of shopping around.
Shop around. Don't be foolish. This right here saves me well over $1,000 a month.
Oh yeah. Shop around and look at like local credit unions.
Credit unions and community banks.
Yes. So those are our 2 best decisions. And you don't have to like apply everywhere. Like just talk to a loan officer and they can tell you all of their like details and what they can do.
Yeah, I didn't apply at any of these places. I just called bank after bank after bank after bank after bank and I said, what's your portfolio commercial loans look like? You know, what is your interest rates? What's your arm lengths? What's your amortization time? And I got that all figured out and I found the best spot. Actually, U.S. Bank was the second closest.
That's impressive.
That doesn't even make sense.
No.
But anyhow, so
your portfolio
loan with Wisconsin. This is different than the typical loans, and I really, really like this. So I got a 25-year amortization, so 25-year long loan. I had a choice between a 3-year, a 5-year, a 7-year. They didn't offer me the 10-year, but I was like, what can we do? And they're like, hey, actually, we can approve it. And they approved me for a 10-year.
That's dope.
That's dope. Here's what happened, though. Their base, their prime loan amount, their interest rate was 3%. Okay?
Okay.
If I went with the 3-year arm, they would have given me an interest rate of 2.875. They would have lowered it for me to go with the 3-year arm.
But it's more risky if interest rates, as we know, interest rates are increasing.
And so, dude, if I did that at the end of last year, dude, by 2025,
like it'll probably be over doubled.
I would imagine so. So anyhow,
the fun part about this.
Yeah, I had a 3-year. The 5-year option was at 3%. The 7-year option was at 3.25%. And 3.5%, and the 10-year option was 3.75%.
Okay.
So I was like, hey, you know what? I did the calculations. I think it was something like, the 3.5 compared to the 3.75 was like $200 a month that it costed me. But I was like, fuck it, that's fine. I don't really care. So I took the extra 25% interest rate because I wanted at least a 7-year. So 3.75, 10-year arm. At the end of the 10 years, it does not come to maturity at 10 years. That lock just ends at 10 years, and then it's a monthly variable interest rate. Why this is amazing. I talked with the banker and stuff. I can't refi at 7 years. I can't lock in a new at 7 years. But he says from year like 8 to 10, if interest rates are low, there's a very, very high likely chance that I will be able to lock in from year 8 to 10 with a low interest rate.
That's so dope.
Now, if I reach year 10 and interest rates are higher than I want to lock in for, right? I can just sit on a monthly variable I can sit on that for the next 15 years if I want. The banker said he's got people that just sit on that because interest rates aren't where they want. And I can just sit on that variable monthly interest until rates are low enough, and then I can lock them in.
And that's like good to do too, because you'll know plenty ahead of time when rates are going up and down. So I'm sure a lot of those people that are at the monthly thing are probably just like, you know what, I'll lock it in now.
Right, yep.
Knowing that it's going to go up at least 2.5% the next year.
Dude, I was reading some shit. It was like 80% of homeowners or investors refinanced in the last 2 years. 80%.
incredible.
Yeah, you want to know what's crazy? Think of all the 5-year arms that are coming up. Dude.
Oh, yeah, people that probably did it right at 2020.
I'm telling you right now, there is a possibility, and this is just me foresighting. People, whatever. I'm just foresighting. I think 2026, there might, if things continue to go the way that we're seeing the trends are going right now, there's going to be, I believe, a lot of like foreclosures or a lot of...
So, it's going to be a buyer's market.
It's going to be a buyer's market, and I say that because people won't be able to afford their loans if their interest rates go to 7%.
Yeah.
You know what I'm saying? That is just me speculating that if things continue on the way they are and interest rates go from people were locking in interest rates at like 3%, 3.5%. At the end of that 5 years, if their shit goes to 6-7%, they might not have been calculating for that. They could be in for a world of hurt.
Because what if it can go up to like 7 or 8% when we still are okay?
Every property we have, at a minimum, some or more, at a minimum, our worst property can go to 7% interest rate and we'll break even.
That's awesome.
Yep, and that's with saving for CapEx, maintenance, and vacancy.
And that's how you do it right.
I guess so. What else? So that's variable interest rates.
Yeah, I really liked the point they said for every 1% move in interest rates is a 10% change in buying power.
Yep. So we talked about this on a previous episode.
Yeah, we did.
But
I still love saying it, though.
For every 1% increase in interest rate, so right now the prime is at, for a 30-year, it's at like 4.1, I think, depending on the market, 3.75. It's like 3.75, 3.875, 3.875 to 4.1 right now is what I've been seeing. Okay, following? Mm-hmm. So if that goes to 4.8 to 5.1%, typically in a normal economy, housing prices would fall by 10%.
Yeah.
But right now, there's still such a high demand for houses. I don't foresee that happening. I don't foresee housing prices going down all that much.
I don't honestly foresee it until probably the end of 2023.
I think so many things have to go wrong for it to happen. Mm-hmm. And like our life cycle we're in, I've looked at the life cycle of real estate, and I know it's coming. It is coming, but I don't believe we're in that stage yet. I think we're a few years out.
I think it's going to be a slow decline.
Yep.
It's not going to be anything like huge.
Unless there's a full correction for inflation. If we decided that we're not going to do these 6 hikes slowly and the 3 hikes next year, and we decide, bam, we're going to implement it tomorrow, that's where we'll see the crash. That's where we'll see the depression. But as long as we play it smart, I don't foresee it happening.
Yeah. There's only one more point I wanted to make.
What's the last point?
Do you think interest rates rising, and like demand and supply chain issues, do you think we're going to see more smaller cars instead of big SUVs like we've seen the past probably the past decade?
I think it's really going to depend on our economy and how well the U.S. economy is doing. Mm-hmm. If inflation stays this high, mm-hmm. if gas prices continue to be elevated and we do not start producing our own fuel here in the United States, because we're either the first or second largest oil reserve in the world, okay?
So that's oil that we're just hoarding and not using?
Correct, because we want to be green first off, we want to be green. Have you guys looked into how much fucking fuel it takes to transport a ship from overseas to us to give us oil?
I bet you it's a lot.
Dude, it is a disgusting amount. I don't remember the amount.
Okay, Shaun, that's not what this podcast is about.
But it gets out of hand. Oh, okay. So, anyways, I think if we become oil independent,
mm-hmm. again,
then I do not think we will see that happen. Gas prices will come down. Our economy will be extremely strong if we can be independent in a lot of our stuff we manufacture and produce and consume. I think we'll see bigger. If we continue to import most of our stuff, most of our oil, most of our manufacturing, a lot of the stuff that we consume, and we continue to get more and more dependent, I think we could see vehicle sizes actually go down and smaller because our economy is going to be going down. And I mean, that's a trend that they've seen over the past fucking 50 years is as the economy is doing better, the cars get bigger. As the economy does worse, cars get smaller.
Yeah.
So I think it's just depending on how independent our United States can be.
Yeah. So definitely like around like 2008 is when small cars were like a huge thing again. And it was probably for a while, like at least, I was in college when I started seeing more trucks and bigger SUVs again.
Right, when Obama was in office?
Yeah. But I mean, it was like towards the end of his reign, I think, is when we started seeing more.
The economy started going up again.
Yeah.
Yep. But 2008 was the housing market crash and shit, and there was a lot of uncertainty.
Yeah. So I think once that hit, a lot of people started selling their big trucks, getting smaller cars again, because gas prices were high.
Yeah. Oh, yeah, definitely.
Yeah, I think it was, we figured out the other day, it was like 2010 when they were really high?
2009?
10.
10, 11, 12, 13.
Yeah.
Yeah.
I know I was driving for part of it.
Okay, that's what we got.
Cool.
Anything else?
Follow us on Tutors of Life on Instagram and TikTok.
And Facebook. And check us out on tutorsoflife.com for our blogs.
And check out our YouTube.
Yes, watch our YouTube.
There we go.
Tutors of Life. Okay, bye everybody.
Say goodnight, Sean.
Good night, Shaun.
Tutor.
Sam.